When you look at a company's financial statements, we pretty much take the numbers at face value. I mean, cash in the bank, that's easy enough to check. But some assets are, well, they're a lot messier. They exist out in the real world, taking up space in warehouses and factories. And that's where everything gets a whole lot more complicated.
So how in the world do you put a precise dollar value on a massive warehouse that's just full of stuff? It's not just a number you can look up. We're talking about actual pallets, boxes, and raw materials that can be moved, they can be damaged, or, and this is a big one, they can even be hidden.
And that right there is the real kicker. For so many companies, inventory is one of their absolute biggest assets. But because it's physical, it's incredibly vulnerable to being misstated, whether that's by a simple mistake or sometimes by design. This risk is exactly why auditing inventory is such a high-stakes game.
So this gets us to the core challenge. Auditing standards are crystal clear on this. If inventory is a big deal for a company, the auditors can't just sit in an office and trust the paperwork. No way! They have to get their boots on the ground. They have to be there for the physical count and gather their own evidence that the stuff not only exists, but that it's in good shape.
Now, before we go any further, it's super important to get this concept down. The goal of an audit isn't to achieve 100% perfect absolute certainty. It's impossible. The goal is what we call reasonable assurance. It just means that auditors create a really solid process to get high confidence that the numbers are fair. They can't check every single box, but they can build a defensible process that's designed to catch what matters.
Okay, so let's think about this like a detective story. A good detective doesn't just show up to the crime scene cold, right? They do their homework. Well, it's the exact same thing for an auditor. Some of the most important work they do happens long before they ever step foot inside that warehouse.
This pre-count phase is where they find all the early clues. They're digging into the data, seeing what's flying off the shelves, and more importantly, what's just sitting there gathering dust. Old inventory could be totally worthless. They'll also dig into any adjustments or scrap reports to look for weird patterns, like a huge write-off right before the end of the year. It's all about using the data to sniff out the red flags before they even get on site.
And this really hits the nail on the head. All that prep work is so vital because, well, you just can't audit what you don't understand. Is the company making super complex microchips, or are they trading in giant piles of sand? Every business is different, and regulators see it time and time again. When audits go wrong, it's often because the auditors just didn't get the business.
All right, now we get to the main event, the climax of our story, the physical inventory count. This is it. This is the moment where that clean paper trail, all the spreadsheets and reports, comes face to face with the messy, physical reality of the warehouse floor.
The second they're on site, an auditor's senses are on high alert. Is the warehouse a chaotic mess? Well, that makes it way easier to miss things or count them twice. Are the count tags just lying around for anyone to grab? Are the employees nervously trying to steer them away from a certain corner? And the big one, is anything moving? During the count, there's supposed to be a total movement freeze. Seeing a forklift in action is a massive, massive red flag.
Okay, so check out this fundamental technique. It's brilliant. The auditor does a two-way test. First, they go list to floor. They pick something from the company's official inventory list and say, "Show me." They go find it on the warehouse floor. This is to catch ghost inventory, stuff that's on the books but isn't actually there. Then they flip it and go floor to list. They'll point to a random pallet and say, "Okay, now show me this on the list." This is to catch inventory that exists, but for whatever reason hasn't been recorded.
But you see, at the end of the day, this is not just some simple box-checking exercise. An auditor's most powerful tool is a mindset, professional skepticism. It means having a questioning mind, always challenging what you're told and always demanding to see the evidence. It's that gut instinct of a detective who knows that things aren't always as they appear.
And that skepticism is so important because, believe me, auditors are specifically trained to look for signs of fraud. People can get creative, you know? They might backdate shipping documents to book a sale in the wrong period, or they might just hide a bunch of obsolete junk in the back corner so they don't have to write it off. The auditor's job is to know these schemes exist and to be on the lookout.
So, the physical count is done. The hard part's over, right? Not so fast. Our detective's investigation is not finished. Now, all that evidence they gathered on the warehouse floor has to be carefully tied back to the final numbers you see on the balance sheet. A lot of the time, the count doesn't happen on December 31st, so you've got this gap in time. To solve this, auditors do what's called a roll forward.
They start with the number they verified on the count day, and then they test literally every single transaction between that day and the year end, every purchase, every sale, to roll that verified number forward and arrive at the final audited balance.
And getting that final cost right can be pretty complicated too. For a manufacturer, inventory has 3 basic layers. First, you've got the raw materials. Then you have work in process, which is the materials plus the cost of labor and factory overhead. And finally, you get the finished goods, ready to be sold. Every single one of those layers is a place where errors can creep in.
This brings us to one last crucial idea: how you value the stuff. See, you can't just value inventory at what it cost you to make it. Accounting rules say it has to be valued at the lower of its cost or its net realizable value. And NRV is basically what you think you can sell it for, minus any cost to finish it and make the sale. Think about it. If you have a warehouse full of last year's smartphones, their NRV is probably way, way lower than what they cost to build.
So, after all this detective work, the data crunching, the on-site inspection, all the testing and valuation, you might be asking, what's the big deal? Why does this incredibly detailed, and let's be honest, sometimes tedious process matter so much?
Well, the stakes are just enormous. For investors, if the inventory number is wrong, you're getting a totally misleading picture of the company's health. For banks and lenders, it could mean the collateral for their loan isn't worth nearly what they thought. And for the market as a whole, it just chips away at the trust that holds our entire financial system together.
Because in the end, an inventory audit is never, ever just about counting boxes. It's a really complex investigation. It's all about bridging that gap between what's physically real and what's on a financial report. It's about making sure that we can all trust the numbers that make our economy run.
And that leaves us with one final thought, doesn't it? As our world gets more and more digital, full of data and things we can't touch, the messy, physical reality of a warehouse is a pretty powerful reminder. How do we make sure that the numbers on our screens always reflect what is actually physically real?